As Alan mentioned, nervous Australian consumers have contributed to some fairly soft retail figures lately. Indeed, the weaker than expected inflation figure is largely due to prices falling across a variety of goods, from computers to groceries. So what impact are these tumbling prices having on the retailers and their margins? Neil Woolrich reports.
They say retail is detail, and for the past 2 years, Ian McLeod has been casting a keen eye over every aspect of Coles supermarkets. He was brought in by Coles' new owners, Wesfarmers, who hope to reel in the biggest fish in Australia's grocery business, arch-rival Woolworths.
Look at the eye, look at the gill.
Yeah. Customers like it as well.
They love it.
The catch of the week for investors was Coles' sales numbers, which rose by more than 4% for the June quarter. That's more than double Woolworths' sales growth for the same period, a result which underwhelmed the market and has investors increasingly confident that Coles' turnaround story is the real deal and not just a fisherman's tale.
So this is more about Coles versus Coles rather than anything else. And recognising opportunity in the marketplace and seeking to offer consumers better value and better quality products and better service to get more of their share of their spend into Coles.
Coles still has plenty of ground to make up, with Woolworths food and liquor sales running at almost $35 billion a year compared to Coles' $24 billion. But as the supermarket heavyweights slug it out, consumers have been the winners, with Coles reporting a drop in prices of more than 2% for the June quarter.
Well, I think we've tried to drive that, if I'm honest. I mean, before we arrived, you would normally expect about 3 to 4% volume growth coming through the marketplace, and there's probably a general history of 3 to 4% price inflation coming through. What we recognised here is that if we were going to drive a change in terms of how Coles was perceived by the customer base, we have to improve our overall value, and it has to be, material.
And price deflation has become a feature across Australian retail this year, with barely a day going by without another sale being announced.
There is a lot of discounting going out there, but you can only discount so far. And the reality is that, we're all very competitive all the time. I mean, we're in an industry selling furniture, electrical, computers. I mean, that is very, very competitive. There are a lot of players and it's a very competitive business.
The squeeze on prices is getting some investors worried about profitability as well. While the market welcomed Coles' sales growth, analysts at Macquarie Group and Citigroup revised down their earnings forecast for Wesfarmers, in part because of tightening retail margins. Jerry Harvey says Harvey Norman's August profit report will be fine, but he's worried about the plunging price of flat-screen TVs.
The units are not down. There's just as many being sold, but they're being sold for, $1,000 now, and a year ago they were $2,000, and 2 years ago they were $3,000. So you've got this massive drop in price.
Established retailers are also feeling the heat from emerging competitors like the discount warehouse Costco, which opened its first Australian store nearly a year ago.
We came into the market thinking there would be a lot of competition, in every category that we operate in, and we haven't been disappointed. There's certainly a lot of discounting on seasonal merchandise, but we came into the market and priced our goods, with the Costco methodology in mind.
But for Costco's Patrick Noon, simply finding land to build new stores is a challenge in itself.
We are a big business, a big floor plate of around 14,500 square metres. So I was making the point this week that there's not a lot of available floor space for retail operations available right now. But we've been able to develop the Dockland site, we're developing the Auburn site in Sydney, and there's a lot of opportunities in the major cities of Australia to develop similar sites.
However, in the big shopping centres and on High Street, some landlords are now struggling to find tenants, with vacancy rates rising as consumer spending continues its flat spot.
Particularly what we call the strips, the retail strips that are places like the sort of Chapel Streets, the Toorak Roads, the Oxford Streets in Sydney, is where we're seeing vacancy rates rise the most, moving up now to between, say, 4 and 6%, where traditionally they'd be quite tight, below 2%.
Commercial property analyst Kevin Stanley says that's meant development plans are now being put on hold, a much different story to last year when retailers were still riding a wave on the government's cash splash.
At that time, retailers and the chain retailers were actually in expansion mode, quite strong expansion mode, trying to put their foot on new sites and better locations. And those kind of plans we're seeing from the chains have now stopped, and they're just really focusing back on their business and making sure they get through this flat time.
Given this week's surprisingly low inflation numbers, the Reserve Bank is widely expected to leave interest rates on hold for the time being. While supermarkets are doing their bit to keep prices down, retailers expect price pressures to re-emerge elsewhere.
From our perspective, I can see low levels of inflation continuing for the medium term in food. That's what I would anticipate. There are other areas within the economy where I think there are concerns around inflation. Energy is one in particular, and that focuses right the way through to the consumer.
You'd have to bet long term in the next year that the interest rates will probably go up, because it looks like we're going to have a reasonable amount of growth in the economy.
But belt tightening is likely to be the order of the day among consumers, forcing retailers to come up with fresh ideas to lure the shopping dollar.